Hello everyone and welcome. It's great to see so many of you here today. I'm really pleased to introduce our speaker, Professor Neamtu Thanassoulis from Warwick Business School. John is a Professor of Financial Economics and the course director for our MSc in Central Banking and Financial Regulation. John's work focuses on banking, financial regulation, ethics and misconduct. At Warwick University, John is well known for his research on how banks should be regulated, structured, and particularly in the aftermath of the financial crisis, his work has contributed to some of the big debates around banking reform. Today's talk explores the heated debate as to whether retail and investment banking should be separated. John has a recently published paper on the UK's current policy in this space, ring fencing, a policy which other countries have not, at least so far, followed. I really hope this talk will spark a great discussion, so please join me in welcoming to the stage Professor Neamtu Thanassoulis.
Excellent. Thank you very much, Lauren. So if I could get my slides to the front, that would be fantastic. Okay, so it's my pleasure to get to speak to you today and to talk a little bit about ring fencing and about how we got here. So this is going to be a talk which does a bit of a whistle-stop tour of financial regulation, why it is that we are even talking about ring fencing in the UK, why it is perhaps that we have introduced it but other countries haven't, and that's going to be important as we look to the future to work out whether ring fencing has a good role to play in the regulation of the United Kingdom and indeed perhaps in other countries as well. So let's start this, this sort of hour-long session that we have together by just reminding ourselves a little bit about how we got here. So in the beginning at least since the 1930s, retail and investment banking were separated. And for that, we have to thank Senator Carter Glass and Republican and House of Representatives Henry Steagall for the Glass-Steagall Act, 1933. And what that act required was that it required banks to keep separate investment banking and essentially retail banking. So it was the case that retail banks weren't able to underwrite, hold, or deal in corporate securities, and that created a separation leading to some very large and very famous American investment banks, which went on to have global prominence. The act lasted until 1999. A lot of retail banks lobbied quite hard for its repeal, and it was repealed eventually by President Bill Clinton. But following the 2008 global financial crisis, the wisdom of allowing universal banking, so allowing commercial banking and this sort of investment banking and retail banking to come together, was again in the spotlight, and people were wondering whether it was really a particularly good idea. So at the same time, at least towards the end, in the sort of late 80s and then in the 90s, we had the Basel process. And that is important to also put in perspective a little bit about why we are where we are. So let's think a little bit about the Basel III process. So we had initially Basel I and II were brought in. And why were they brought in? Well, despite the Glass-Steagall Act, in the late 1980s, there was a big opening up of international banking. A lot of banks were able to compete for business around the world. And these banks were in a rush to tap newly opened markets and capture international market share. And some of the banks did that in a way which didn't at the same time increase their capital base. And so they became quite fragile, keeping their costs low and perhaps, as they saw it, maintaining their competitive advantage. And in addition, as compared to today, the more lax approach to regulation and capital regulation allowed internationally active banks to sort of arbitrage international regulators and choose the countries where the regulations would be least stringent. And so a lot of countries felt this wasn't right, and they were nervous about opening up their domestic markets to this sort of business. And Basel I was the international regulatory response. But right from the get-go, there were issues that we'll come to. What did Basel I do? Well, the Basel Committee on Banking Supervision brought in a number of things that you'll recognize even from today. It brought in the idea that we should need to define a regulatory capital stack, that we need to think about what aspects of the balance sheet, what the capital there is there that could potentially absorb losses, Tier 1 and Tier 2. Tier 1 we now know mostly as equity, but it didn't need to be only that. Tier 2 is sort of gone concern capital. It introduced a way of calculating how much bank capital there was and comparing it in a sensible way to the amount of risk that a bank was running. And so that led to the concept of risk-weighted assets. And there was a minimum regulatory ratio of requirement of this risk-weighted assets for internationally active banks, so that the amount of capital that these banks had to hold in some way was moving in proportion to the amount of risk that they were running. But back then, Basel I, there were problems. So in hindsight, and some extent it was anticipated, but it's important in these processes that the international agreement is maintained. Otherwise, you can't implement these big international approaches to financial regulation. So what were some of the problems with Basel I? So one of the problems with Basel I is that there were uniform risk weights. So in particular, for example, banks which bought the debt of sovereigns of their own countries usually, that came in with a 0% risk weight. And it didn't matter who the sovereign was. So that there wasn't a sense in which some countries were safer than others. Clearly, the markets might think that some countries are safer than others, but no country was willing to accept that their relative lack of safety would be codified into international agreements in that way. So all countries were treated the same as completely riskless to be lent to. At the other end of the scale, all corporate debt had 100% weighting. So it was completely risky, if you will. And again, no distinction permitted at that time between different types of firm. There are also loopholes in the capital definition. Again, it's important to get everyone to agree. And the definition of capital was quite permissive, quite loose, and so it allowed some countries to be very permissive, essentially of having very little capital in their bank's capital stack. So these were problems with Basel I, and it was sort of understood that there were issues and there was debate, there was work done all at the same time. So then Glass-Steagall was there. Let's keep investment banking and retail banking separate. Then Glass-Steagall was repealed. In the regulatory, the work that was done, we had Basel II come in. That came in 2004. Remember, the global financial crisis was 2007-8. So this was before the global financial crisis. So how could Basel I be made better? The aim was to make the whole system more sensitive to bank risk. So 3 pillars were introduced in financial regulation. What were those pillars? Okay, well, the pillars were that we had to have a minimum capital requirements. They, to some extent, were there before. They became more stringent. We added in a supervisory review process so that the regulators who were regulating different banks would actually supervise those banks and assess whether or not the banks were being run safely and carefully. And then risk disclosure allowing for market discipline. So what that was saying was that by banks making available the information about what they're doing and the risks that they're running through their disclosures to the financial markets should allow financial markets to price the risk that banks were posing more accurately, and in particular, the debt that banks were issuing on the open markets, the interest rate should reflect the riskiness of those banks. And if the banks were choosing to run more risky business models, then the interest rate demanded would go up, and that would represent a cost to the bank and affect the bank's profitability. And that should lead to a sort of self-correcting mechanism. So that was the idea of Basel II. But with the benefit of hindsight, Basel II had problems, and it didn't take long for those problems to manifest. So we had, remember, the Glass-Steagall, let's keep banks separate, investment banks, retail banks. Then we put them together. We tried to manage it through regulation. Basel II was how we were trying to manage it. But the financial crisis exposed, with the benefit of hindsight, problems. What were some of the problems? Tier 1 definition was left very vague. It could be complied with, so the capital, it could be complied with largely without using equity. Okay. There were flaws in the risk management models used by many internationally active banks. There were errors that crept into the prediction accuracy of credit rating agencies. Failure to capture major on and off balance sheet risks, as well as derivative-related exposures, and there were low capital levels, which made the banks unable to absorb significant losses. So these were problems which manifested in Basel II, led to the, and we found out subsequently because of the big financial crisis. So enter Basel III. If you'd like to know more about Basel III, then there's a great YouTube video, which I'm not going to play you now, which gives you the introduction to Basel III. Let me tell you a little bit more about it. Okay. So Basel III is really a capital story in 4 parts in the main. Okay. So the first thing that happened in Basel III was that there were enhanced minimum capital adequacy requirements. So more capital was needed. And these are agreements around the world, okay, that apply to banks. Counter-cyclical capital buffer, that was a new thing that was introduced. And what that does is it allows domestic regulators to increase the amount of capital that individual banks have to hold, and they can do so to reflect the macroeconomic state in which their economy is. So the idea is that if the economy is running hot, that's when banks tend to lend more, and so the regulator would have the ability and the authority to require more capital to be held to try and lean against that growth. And then the idea would be that in a slump, when banks rein back and decide not to lend, which prolongs the slump, that countercyclical ratio could be relaxed a bit. A leverage ratio was brought in, which basically said this whole idea of using risk weights leaves us open to the problem of what is the actual risk that we are using, and is there just too much maths, and it leaves banks able to game the system. So let's have something that's very, very clear and basic, which is the idea that just straightforward market levels, how much debt have you got, what's the size of your balance sheet, and you can't have too much debt as compared to the total size of your balance sheet. And the capital conservation buffer is, again, a type of capital rule. It's slightly different in that banks are permitted to go into it, but if they do so, then it affects the way that they, the flexibility that they have to run their bank. And in particular, for example, it means that if a bank breaks into its capital conservation buffer, it's not allowed, or it's restricted on the dividends it can issue and the bonuses that it can pay. Okay, so those are the capital stories. And back in from 2011, this is from the Basel Committee, and this was then the current percentages that are required of Tier 1 capital, so total of, of capital Tier 1, Tier 2, 8%. You've got the conservation buffer, and that comes up, so on, as you can see. In addition, okay, so it wasn't just capital. There were some other aspects that were brought in, and this top one was is going to come up in this talk a few times today. Okay, so liquidity and funding. So there were concerns that the financial crisis highlighted real problems with liquidity, and liquidity crises turning into solvency crises for banks. What that means is banks might feel that they have assets on their balance sheet which have value, but if the markets are not functioning well, not liquid, if there aren't buyers and sellers at a particular point in time, then if a bank needs to raise cash, needs to raise liquidity, it has problems, because if it's forced to sell, it will have to sell at very disadvantageous prices, and that in itself can create a problem. So that was something that manifested in the global financial crisis, and it led to the idea of liquidity coverage ratio. So this is the idea that banks have to have enough high quality liquid assets to survive an acute stress scenario for 30 days. Okay. The net stable funding ratio is similar, and it works on the idea of having that the funding that funds the bank is sufficient and is stable. We'll come back to the LCR, as it's known, the liquidity coverage ratio, in a little bit. But the UK did a little bit more. Okay, so those were the Basel III approaches to what we learned from the global financial crisis. That's the changes that were made to global levels of financial regulation. The UK did something more, though. The UK introduced a ring fence, okay, and it was introduced by the Independent Commission on Banking. Okay, so let's tell you a little bit about the ring fence. So the ring fence, the Independent Commission on Banking came to the view that structural reform of universal banks was required. And what was required was, and this has only happened in the UK, was the creation of a ring fence. So what is this ring fence? So the idea would be that in the overall banking group, there would be a ring fence part, a subsidiary, which this ring fence part is the part which will do the UK's retail banking activities. So think lending and deposits from people like you and me, individuals, and from small and medium-sized enterprises and businesses. Okay. And this subsidiary, which is focused on the UK, part of the overall banking group, it would have to be legally, economically, and operationally separate from the rest of the banking group, having its own very distinct governance arrangements. If you think about it, what this means is, it means a couple of things. But one important thing it means is that the subsidiary, the retail bank subsidiary within the overall banking group, can be hived off or separated very, very rapidly, for example, over a weekend in some sort of emergency scenario, so that resolution, resolution becomes much easier for the regulator, for the Prudential Regulatory Authority, which is the body that does it in the United Kingdom, to do if they had to. So they could save the retail part if they felt it was necessary. Okay. Why did the ECB say this was important for the UK? Well, they did a very thorough analysis. It took a long time, but some key themes to bring out are, first, if there is a financial crisis, the ICB made the point that it can be very costly, and the global financial crisis was incredibly costly from a UK perspective. So in 2009-10, as we were dealing with the aftermath, the government deficit was over 10% of GDP. We had huge losses on the overall level of GDP that manifested, and the government had to spend an awful lot of money, so very big bailouts. So, for example, the Royal Bank of Scotland, the government had to buy 80% of its equity. For Lloyds Bank, it was something like 40% of the equity had to be bought. And the UK is different to many other countries in the following sense. It's particularly exposed to its banking sector. So when you think of big banking sectors, then you might imagine, you probably think the United States is going to have the largest banking sector. And indeed it does. But as a proportion of the overall economy, of the proportion of the size of the market and the economy which backstops that financial sector, in the US, it's almost 100%, 1 for 1. But in the UK, the banking sector was almost 4 times as large, more than 4 times as large, as the total UK economy. So the ability of the UK sovereign to stand behind big problems in the banking sector are more limited, which is one reason why the ICB said that the UK needs to be particularly careful with how it runs its banking sector. The ring fence that we're talking about, it has parallels with only one other country that's come close to doing something, and that country is Switzerland, which also, as you can see, is very much on the right-hand side of this chart. So the ring fence has come in. So the ring fence, why would the ring fence be a good idea? Okay, so what would the ICB argument be? And it's still relevant today because we're still debating today whether ring fencing is a good idea. Well, I've alluded to the first one already. Ring fencing makes bank resolution easier so that if there is a crisis that hits a bank, a big international bank, it becomes within the policy toolkit of whoever is running the government at that time. It is within the government's toolkit to say, you know what, I want to protect my domestic savers, and I don't have the money, or I wish not to protect all the rest of the bank. Okay, so for example, in the case very famously in the UK context, the Royal Bank of Scotland went to the then Chancellor of the Exchequer and basically said this bank will go bust by the end of the day and won't have money in its cash machines if you don't bail us out. And the Chancellor of the Exchequer said, well, can I just protect the deposits of UK depositors and just their money? And the answer was legally, no, you can't. You have to bail out everything or nothing. And that is now no longer the case with ring fencing. It would be possible to separate out if the government wanted to. That's a separate question, whether they would want to or not. But if they did want to, then ring fencing would make that easier. Okay. The second thing is that the shock, whenever the next financial crisis comes, might not come from within the domestic space. Okay, no, within domestic banking. It might be shocks from outside. It might be international money markets which have caused problems, which then ripple out towards the UK, for example. And by having the ring fencing, retail banking can be insulated from those shocks. And the quid pro quo is that international banking, so the argument went, can be saved from excessive and intrusive amounts of financial regulation. It can stay at whatever is agreed internationally and compete on a level playing field, whilst offering domestic savers slightly more protection. Okay. So that's what the ICB argued. They argued that we need to identify, and they claim they did identify, the part of a universal bank which really cannot be allowed to fail. Okay, which at the end of the day, you know, trying to be as realistic as possible, the government just would not allow to fail. And with the implication, of course, is that in extremis, stuff that is outside the ring fence, in extremis, the government might say, you know what, it's going down, we're not helping. Okay, so that is the sort of the argument behind the ring fence. Now, the ICB, there are criticisms of ring fencing, many, as you would imagine, given that the UK is the only country that's done it. And the ICB were very aware of some of these issues and took them on at the time. Because at the time, there was a constituency who said, this is a mistake. You know, the banks are much more efficient if you leave universal banks together. We had Glass-Steagall. That was a mistake. It's taken 60 years to correct that mistake. We've now got universal banks again, and now you're coming and breaking them up, and in a sense breaking them up, although not, you know, this halfway house. But the ICB's response would be, or was, that they couldn't see how the financial stability benefits that you can get from resolution, protecting important payment services from these wholesale banking problems, and the ability to credibly stop too big to fail, how that can be achieved without some sort of breaking up the banks, or if you don't do that, much higher capital requirements which would inhibit the competitiveness of banks on the international markets. There was a different constituency that said you didn't go far enough. Okay, this is, we don't want these big universal banks. We should go back to Glass-Steagall. We should have separate retail banks that protect money for depositors and let the international casino, people often talk about casino banking who believe in this sort of thing, let those just be separate businesses that go and do their thing on the international markets. And what the ICB said to this constituency was, if you break up the banks, then you remove the safety channel whereby if problems happen within the domestic space, within the UK, for example, with some bank that has international business, you can be bailed out by profits elsewhere in the world. Whereas if you cut that off, then there'll be that cuts off a potential safety mechanism from elsewhere. Okay. Now, let's now we're moving much forward to the present, and ring fencing has come in for some criticism. And most prominent, I think, of that criticism is the SCIOC review, which was published quite recently, a few years ago, and I think has been very influential in with a number of policymakers and a number of commentators. So ring fencing, as SCIOC points out, has only been adopted really by the UK, certainly in its current form. And now the government has been suggesting that it may need to be changed, or it may not be appropriate, or perhaps it's too strong, or maybe it's just we don't need it, to call a spade a spade. And so we've got ring fencing's, SCIOC says ring fencing's benefits will diminish over time. Okay. Banks have incurred, according to SCIOC, relatively small economic impact so far, but that could increase over time. And the reduction in too big to fail is agreed that that's there, but it's not due to ring fencing. It's rather attributable to a UK resolution regime, although I think the review would accept, the SCIOC review would accept that that hasn't really been tested with a big failure. We haven't thankfully had a big crisis since the last international global financial crisis. And further, as SCIOC points out, the key critical question is it really credible that that a policymaker, that a Chancellor of the Exchequer would agree to let the non-ring-fence bank, the subsidiary of the big bank, the banking group outside the ring fence, is it credible that that would be allowed to go down because it has critical functions of its own, as SCIOC points out, and would a Chancellor really sort of permit those? And that is an important question, because if this is a policy tool that sort of in a sense would never, one cannot imagine it ever being used, then there are clearly costs to and impositions on the banking sector. And why would we do it if it has no, if it could never plausibly ever be used? So those are the sort of some of the critical services that SCIOC argues for. So this is an international question. Okay, so the question is, does legally dividing a bank to create an easily hived off part which has lower risk, is that a good idea, or is it just too expensive? Okay. It might have unintended consequences. So if one essentially declares a guarantee over a retail bank, over a retail banking subsidiary, does that lead to moral hazard in that subsidiary? Does that too big to fail go to the necessarily result in the ring-fence bank becoming more risky because it knows the government's going to stand behind it? And what about the unprotected part? What about the non-ring-fence bank? Now we presumably, if it's credible, say, look, this actually is no longer too big to fail, and the regulator might well let it go down. Well, what does that do? Does that damage that part of the bank? Does it make its ability to function more difficult? And further, as some commentators have pointed out, the US, in a sense, has always had something that looks very much like a ring fence. In fact, two of them. It's got an outer ring fence in the form of the Bank Holding Company Act. That's what was used to enact the Volcker Rule. And it has an inner ring fence in the form of the Banking Charter, which prohibits non-financial commercial activities from the entity which holds that charter. But neither of these were used in the financial crisis. The Fed in the global financial crisis, even though it in a sense had the legal power, didn't separate out a little part of one of its big banks and say, we'll protect just that part and let the rest go down. So what do we infer from the wisdom or otherwise of having a ring fence? So should there perhaps be a ring fence for the US? What are the costs of having it? What are the benefits of having it? Okay, so that's what I want to talk about, and that's where some work that I've done with two colleagues comes in. So this is what the rest of this talk will be about. So we want to ask whether ring fencing has worked on its own terms. Does it make banks safer or not? And to do that, we have a paper, the ring fencing bonus, which is forthcoming in the Review of Finance. If you scan the QR code or you can press the link, you can see it on the Review of Finance website. And it's joint work with my colleague here at Warwick, Erten, and with Ioana Neamtu, who was at the Bank of England and is now at the Federal Reserve. Okay. So let me take you through a little bit about what this paper does and some of the insights that, that it offers. Okay. So again, reminder, ring fencing, but with a little bit more detail. So ring fencing required a part of the bank, the subsidiary that does the retail domestic part, to be its own separate entity. And it doesn't apply to everyone. It applies to UK banks with core deposits, so meaning retail, so people like me and you, and small and medium-sized businesses of over 25 billion, measured on a sort of 3-year rolling average. So over 25 billion, then if you're a banking group with that many core UK deposits, then you have to have a ring-fenced entity. So you'd have multiple subsidiaries. One was ring-fenced, and others, there'd be typically many others, which would be non-ring-fenced entities, and we'll call them NRFB, non-ring-fenced bank, all within the overall banking group. Some groups, many groups actually, don't have that quantity of UK core deposits, and then they don't need to be ring-fenced. And we are going to use the repo market. And why are we going to use the repo market? So what is the repo market? And then I'll tell you why it's a useful way to really start to understand how risky banks are. Okay. So repo, or repurchase to give it its proper name, is where one bank or large financial sort of entity borrows cash from somebody else and gives, in return, gives bonds or some security. And it's a repurchase agreement because when if you like, I sell you my bonds, you give me cash, but I promise to repurchase them tomorrow at a particular price. So I'm definitely going to repurchase, which means pay you back your cash, you give me back my bonds. Okay, so that we have this repurchase agreement, this repo, where bonds and cash change hands with an agreement that the following day, and it's usually just overnight, we're going to swap them back so that I have to pay you back, and in a sense, I'm buying back my bonds. Okay, so for the party which sells the securities, the cash borrower, the transaction's a repo. For the other side of the party, so not the cash borrower, but the cash lender, then it's a reverse repo. And so the repo market is basically the way banks do overnight managing of their cash reserves. And it's the way that very large financial institutions like pension funds, like hedge funds and insurance companies, that they manage their access to pounds and liquidity. It's an incredibly important market. Okay. Now, why is it useful? Okay. It's a really fantastic laboratory to use. Okay. Why? Because we have very sophisticated entities, insurance companies, big banks, hedge funds, and the like, who are coming multiple times a day to bilaterally agree the price at which they're going to lend money for 24 hours to each other, backed by incredibly safe collateral. So it's a constant judgment of one professional entity on its peers as to how risky that entity is right now. Okay. And pension funds, for example, will be doing this multiple times a day with multiple different dealers, so that you see a comparison of the interest rate at which, for example, the pension fund is willing to park cash with one dealer versus another dealer versus another dealer. Okay. These prices are negotiated by professionals who are informed, okay, who are in a position to judge exactly how risky or otherwise their counterparties are. And if a pension fund thinks that one dealer today is more risky than another dealer, then it would require a change in the interest rate at which it lends money. So, for example, if one dealer, A, let's say, is thought to be very, very safe, then the pension fund would be happier parking cash there than a different dealer, and so would be willing to do so for a lower interest rate. Okay. So the interest rate will reflect the riskiness that these informed people see about each other. It's not measuring duration risk. The duration is very, very short. It's not measuring market risk because we've got the collateral backing. It's measuring the riskiness, the riskiness of these institutions. And if we control for bank characteristics like liquidity, capitalization, which we do, then we are able to get really tight third-party perceptions of the dealer bank's riskiness. Okay, and to boot, the counterparties trade with multiple dealers within very short time windows, same day often. Okay, so that allows us to say not whether I think ring fencing has made banks are safer or not. It's allowed us to get a window into whether these big institutions, the big banks, the pension funds, the hedge funds, the insurance companies, do they think that ring fencing has made the ring fence subsidiary safer or not? Okay, we'll be able to ask that question. And how are we going to ask that question? We're going to estimate the following equation, the following regression essentially, where we're going to look at the repo rate. So the dealer's repo rate is the price at which they borrow. Okay, so how much is a ring-fenced entity, ring-fenced subsidiary, that would be the dealer, how much is that does that have to pay to borrow cash overnight? It'll depend on lots of things. The particular dealer's business model, it's the collateral that's on offer, the macro controls, who the counterparty is, but we can control for all of those things and separate out the effect of, are you a group which has a ring-fenced subsidiary, or are you not? Okay, and ring fencing came in at a particular day, which we're going to use. The date we're going to use in this study will be the day when the legal entity got court approval for the structure in which the ring fence subsidiary is going to be. Okay, and so that allows us to estimate this equation. So what are we expecting to see? So we're comparing dealers at the moment at the group level, dealers in the UK, some of whom have a ring-fence subsidiary, some of whom do not. There are thousands of counterparties resulting, as you're going to see in data, in like millions of transactions. So millions of prices that have been agreed with these relatively small number of dealers, about like 25, 26, a proportion of whom have got subsidiaries which are ring-fenced and the rest not. And we're going to ask whether systematically, is it the case that a banking group, which has a ring-fence subsidiary, does that change the price it has to pay to borrow cash overnight? Okay. If the counterparties think that having a ring-fence subsidiary is a good thing, makes the group safer, then they'd be willing to lend cash overnight at lower rates. Beta 1 would be negative. If they don't think it makes any difference at all, then beta 1 would be close to 0, or if they think it's made it worse, beta 1 would be positive. And because of these counterparty by day fixed effects, what we're really doing is we're looking systematically for, take a counterparty, a pension fund, on a particular day, so holding all the macroeconomic stuff constant. If it's lending money to an entity, to a group which has a ring-fence subsidiary, does that systematically lead to a change in the interest rate which it demands? Okay. So that's what that equation is doing. How are we going to estimate that equation? Well, we're going to use all the repo data, essentially all the repo data in the UK. So we've got the near universe of repo, reverse repo prices, and it all comes from the Bank of England. Okay. We're looking at dealer client data. There are 25 dealers. A bunch of them were ring-fenced. Okay. So, and that leads to, as I say, about 2 million or something observations. So what are the results? Right. When we look at that equation and we estimate it, are there systematic effects from ring fencing? And if there are, it's telling us how these informed parties view banking groups which have a subsidiary that's ring fenced. So to prepare for that, let's just, before we even do the regression, let's just plot the data. And that's what we're doing here. What this is is, this is saying, okay, let's look at the difference in the repo price, the price to borrow, for banking groups which, in the 6 months before ring fencing came in, banking groups which were going to go on to have a ring fence subsidiary, and then after the ring fence came in, how much they were paying to borrow compared to the control of banking groups which don't have a ring fence and didn't and don't and never did. For the green is the non-ring fence bank subsidiaries, and the red is the ring fence bank subsidiaries. And it's all negative, okay? Meaning that, and for the red, the ring fence bank, it's a lot more negative, meaning that ring fence bank subsidiary is borrowing more cheaply. Third parties see them as safer, but there are no controls in this. It's just the raw data. But you perhaps can see where this is going when we get to the equation estimation, which is here. Okay, so this is at the group level, looking for systematic effects of the price for a banking group to borrow on the repo markets, borrow cash. And where for an entity that has, a group that has a ring fence subsidiary, we've got a whole load of minus signs here and lots of stars. And what that's telling us is that there is a statistically significant reduction in the price that the groups that have a ring-fenced entity pay to borrow on repo markets. Okay. Third parties see banking groups which have a ring-fenced subsidiary as safer. That's what this is telling us. Those banking groups can borrow more cheaply. How big is the effect? The ring-fenced groups are in the sort of base specification pay about 0.89 basis points less. Median repo rate across the sample is 25 basis points. So it's a reduction in overnight on the price to borrow overnight of 3.6%. Okay. Now, where is the effect coming from? If we separate the subsidiary that's ring-fenced from the subsidiary that's not ring-fenced and compare them all to the control of groups which don't have any ring-fencing going on, and ask again, what is the price of borrowing? Is there a systematic effect? What do we see? If we look at the top line highlighted, for the ring-fence bank, the subsidiary, all minus signs, lots of stars. Okay? The ring-fence bank subsidiary itself is the one which is able to borrow more cheaply. Okay? What about the non-ring-fence bank? Has that its ability to access the repo markets, has that been impacted by ring fencing? And not in any important sense. So if you look at this, you'll see that although we start off with some statistical significance in our most basic regressions, when we add in more controls, more things to be to capture, then the significance drops off. And furthermore, the size of the effect is essentially zero. Okay, so if you look, and you look at, you sort of see, so this is 0.02. Here we had 0.002, so it's sort of a tenth as big. So economically, not anything particularly important going on. Okay, so what we see is the effect is driven by the RFB subsidiary. What is this effect that we're talking about? We are using the repo prices, the price of these entities pay to borrow cash on the repo markets from counterparties like pension funds and hedge funds and the like. It's the ring-fence bank subsidiary which counterparties see as safer, and they reward it with a big reduction in the price at which it can access cash. Okay, that's like a 10% essentially reduction. Whilst the non-ring-fence bank, and there was no guarantee about this, there is a concern, one that I shared before I did this research, which was, wouldn't we have negative implications for the non-ring-fence bank because it's now unable to access liquidity from the ring-fence bank subsidiary, and it's been the too big to fail guarantee has been, if not removed, made much less secure, but there's no economically meaningful effect on the non-ring-fence bank. Okay. Now, a little bit more. There's quite a lot more to do to sort of explore this, but I want to make sure that I allow some time for questions towards the end. But let's go into a bit more. So what about stress periods? Okay, so fine. There's a ring fencing bonus, but what happens in times of stress? Does that bonus sort of go away, or does it in some sense get emphasized? Okay, what happens? How do third parties view a subsidiary and a group which has ring fencing in it in a particular in stress periods? Okay, does this bonus remain? And to try and answer that, we used the COVID episode in 2020 as a stress period and separated out the effect over months of the COVID period. And so to do that, we estimated the following equations, very similar to the previous one, but we are splitting out the effect, the consistent effect of being ring fenced for each month of over that COVID period to try and understand how the ring fencing bonus would evolve. Okay. Now, I've cut off this table, the full tables in the graph. 1 and 2 are on repo, 3 and 4 are on reverse repo, which I'll come back to talk about a bit in a moment. So let's concentrate on 1 and 2, and you can only see of that column 2. Okay, where this is separating out by the subsidiary, ring-fence bank subsidiary, non-ring-fence bank subsidiary, separated out by the month. Okay. And so for the ring-fence bank subsidiary, we've got what in March, for example, March 2020, when the effect was at its strongest, strong negative effect, okay, minus 0.1, that's starting from. Okay, so we are borrowing at 10 basis points less. The ring-fence bank subsidiary is able to borrow at 10 basis points less during the COVID stress period, in particular in March. And the non-ring-fence bank, although much smaller, a tenth the size, is also able to borrow in that month much more cheaply. You'll notice there's a lot of stars down here, the reverse repo for the non-ring-fence bank subsidiary. We'll come back to that. It gives us a real insight into what's going on as to what's happening. But what this overall message is that the ring-fence banking bonus has become more pronounced during the pandemic. In other words, what ring fencing has done has created a private sector safe haven bank. Counterparties are willing to pay a significant amount to park cash in the ring fence bank, the subsidiary that's ring fenced, as opposed to elsewhere, is what that is telling us. So the effect is driven by the ring fence bank subsidiary. Okay. And third parties continue to see this, the RFP group, as low risk, lending to it at low rates. Okay. And if you look for wider evidence that this safe haven exists, and clearly if it does exist, it's going to be of value to the overall sector in perpetuating financial stability. And we see evidence consistent with this safe haven approach. So if we look at the COVID period, and we've seen that the ring-fence banking groups, and I showed you for the actual subsidiary, are able to borrow more cheaply. What happened in COVID? Well, wholesale funding. There was an inflow, flight to safety, more money going towards the ring-fence bank, the group which had a ring-fenced entity. Bank deposits, large ones, went up. Other deposits went up. What didn't change was individual saver behavior, retail savings, which you can see from column 2. But those savings are backed by a deposit guarantee through the FSCS. And so that's not surprising. And in fact, that helps to make us more confident in the overall result. Now, reverse repo is the price at which the dealers lend cash. Okay, so the counterparties are borrowing cash. Okay. So if the counterparties are borrowing and the dealers are lending, then that is our reverse repo. And if the risk appetite of the ring-fence banking group or its subsidiary is being reduced, you would expect to see the ring-fence banking group is charging more to lend cash. Let's look for that effect. So if we look at reverse repo, so then we would expect to see that, and we do see that. And if you look in the paper, you will see some of the you'll see that in COVID. I pointed out on the reverse repo, the right-hand side, column 4, that even the non-ring fence bank is increasing its aversion to risk, and we'll explore why. Okay. Now, what's the mechanism? What's going on here? Okay. Well, I think the mechanism from our research is the following. Okay. It's to do with the fact, or it reflects the fact, that regulatory rules, and in particular the liquidity coverage ratio, applies at the RFB subsidiary level and not as it usually does at the highest overall level within the nation, and not at the overall group level. Okay, so you have, because of ring fencing, we've created this subsidiary, this ring fence bank subsidiary, and it has to meet its liquidity coverage ratios all the time at that subsidiary level. So that guarantees liquidity. It guarantees it because it has to be met to satisfy the regulator. Usually a banking group has flexibility to move liquidity between different subsidiaries. That's thought to be a benefit. But in this case, it's not allowed to move that liquidity out of the ring-fence banking group. So third parties can be sure the liquidity is always going to be there. It now doesn't seem quite such a mystery why in stress periods, in COVID periods, counterparties would be willing to pay a premium to lend part their cash in a ring-fence bank subsidiary. Okay, it explains why the effect remains, particularly in times of stress. Okay, and because the subsidiary needs to meet the LCR, this liquidity coverage ratio, it would explain a reduction in the risk appetite. Okay. What about the non-ring-fence banking subsidiary? Okay, so part of the group which has a ring-fence subsidiary, but the subsidiary is not inside the ring fence. Okay, so two things happen. Okay, the first is, okay, so because of ring fencing, the subsidiaries outside the ring fence, are going to be seen by third parties as more risky. Okay, how could it be otherwise? They now don't have access to liquidity that they would have done, and the ring fence and the too big to fail guarantee has been weakened, if not removed. But the non-ring fence bank subsidiaries adapt to that. How can they adapt to that? Well, they need to reduce their risk appetite, which we see as you look at that repo, their reverse repo results 2 slides ago. So we've got more risky, but then adaptation in terms of behavior for the non-ring fence banking group. These net out so that we don't see any effect on the cost of borrowing. That we also see. Okay. Now, a few more things before I sort of stop for sort of any questions. So one of the things people might think is, well, look, if it's that good an idea to have this separate little retail bank subsidiary, can't banks just do it themselves? They don't need a regulator to impose it. But as we know now from the mechanism, if you don't have the regulator, if you don't have the rule that says liquidity has to stay high in the subsidiary, in the ring-fence bank subsidiary, then it doesn't work. It doesn't create the safe haven status. And we can see that directly by asking, when ring fencing was introduced, when exactly did the market reward the banking groups that were going to be ring-fenced? Was it once the sort of separation was created between the ring-fence bank subsidiary and the rest, but not backed by law? So the unilateral part. So before 1st of January 2019, the banks went through a process with the Bank of England and set up their subsidiary, which was going to be the retail part, and had the other subsidiaries elsewhere, so that they separated out their balance sheet and made it all clean and nice and not so complicated for the retail banking part. If that was all that was needed, so if a bank can create the benefits of ring fencing themselves, then when that happened, that top row, ring fencing, comes in, that's when we should expect to see the benefit happen. Or actually, no, is that not enough? There has to be the law that says you must obey your LCR. You will be regulated in a particular way. Ring fencing goes live legally, and in the United Kingdom, the law became live on the 1st of January 2019. That's implementation. And as you'll see, once we had implementation, always gets us the effect. Okay. But ring fencing without implementation, when we start allowing for implementation, all the controls, it doesn't have an effect. You need to have the law. Okay. And it's not, finally, is it a too big to fail effect? Is ring fencing really just a reward for the fact that the Bank of England have said that these entities just can't be allowed to fail? And to stress test that idea, we can add to our analysis of ring fencing some actual measures of the riskiness of individual subsidiaries through distance to default and the Z-score. And if we do that, the effect of ring fencing goes away. So it is a risk effect. It's not a too big to fail effect. Okay. So before I sort of stop and open out questions, okay. So the counterparties, we see evidence from sophisticated, informed investors that counterparties see ring-fence banks as safer, and they're willing to lend to them at reduced rates. They're willing to pay more to borrow from them, and in particular, in stress times, that safety propagates. Okay? The regulations what creates this effect is the regulations applying at the subsidiary level generate the effect. And the non-ring-fence banking groups within the non-ring-fence bank subsidiaries within an overall group are not to any meaningful extent made much riskier. So you can put that all together and basically say, what we found are the costs of ring fencing are less. There's a bonus in terms of the ability to borrow. And we have a benefit for the wider safety of the whole industry, which is that ring fencing has created these safe haven banks, places where other financial market participants want to go to in times of stress. So that helps us capture that, at least on its terms, ring fencing has been successful in because other entities, sophisticated entities, see it as having worked, see it as having created safer banks that they're more willing to park their cash in stress times. Okay. So that's what I wanted to say. Thank you so much for bearing with me. I don't know if there may have been some questions. I think I saw things pop up. So I will try and take some of those questions. So how am I going to see them? Sorry, bear with me. I mean, hopefully the chat, I can't see them in the chat. Is it possible to? Apologies for this. I think we are trying to get the questions back. Okay. Oh, we have a great question, which is essentially, if I'm sort of paraphrasing, it is to say that from the financial crisis to today, the banking system has changed very significantly, and in particular, people have access to a whole host of fintech platforms and other ways of interacting and doing financial services. So do we still need ring fencing, and would it even still be effective? Okay, I think that's a really good point. So there are a couple of things to say to that. So first, on the plus side, so on the fact that there are now other ways of moving money around using blockchain and other types of fintech and financial innovations, mean that the system is more resilient to a bank perhaps failing. And the idea would be that people can use blockchain and the like, and so we don't need to worry so much about protecting banks. That would be the plus. But even putting that forward, I think it's sort of clear that that we're an awfully long way from that. The vast majority of people in a population, you know, the sort of the grandparents, the people who are not so tech savvy and so on, they are using banks in a traditional way, and their savings would need to be protected. So I think although fintech and so on is super exciting, and the future will no doubt look quite different, the issues that surfaced in the financial crisis before, and the reason for and against ring fencing, I think, are still really, really very important. And so this debate stays quite relevant. Now, there's another one. I've witnessed lots of ever changing them. What do you regarding individual risk on? Oh, okay. Okay. So this is, and there's another question which is now pointing out that it's all well and it's all very nice to say, look, pension funds, insurance funds, and the like might take the view that a ring-fence subsidiary is a safer place to park cash overnight than somewhere else. But would retail customers share the view that ring-fenced banks are that good, and are there problems with ring fencing, broader problems with ring fencing? And I think that it's a really important question, because the paper that I've outlined to you does a specific thing. It tries to measure the riskiness of banks from the perspective of sophisticated entities. But ring fencing has some downsides, which, even allowing for safety improvements, you might explore. So one of the big downsides of ring fencing is the question of whether or not it inhibits competition in retail banking, because if you're a bank, a big global bank, and you go over the threshold, 25 billion of core deposits, you'll have to start ring fencing. And for some banks, it's on the record, that's a deterrent, and they are actively limiting their deposits in the United Kingdom to below that level. So that's less entry, less competition, and if there's less competition, we would expect to see a reduction in the quality of service that's being offered to consumers. So that is a live concern. A second concern would be that for the ring-fenced entities, their assets are going to be kept in the United Kingdom. That might be an overexposure to the United Kingdom, although we're in the business of trying to attract money here. But for an institution, an individual bank, it might be that they're better off diversifying, and that's inhibited by the ring-fence group. By ring fencing. The study I had has nothing to say about that, but there are two good points which one might make against ring fencing. Okay, now, really, really good question, which I think you could almost be Skiok could answer it, which is that, look, if you can resolve big banks credibly via, for example, bail-in, why do you need ring fencing at all? Okay, and I think, so my answer to this, and it really comes from a Skiok review, my answer to this is that first if is doing an awful lot of weight there. Okay, so if you can resolve big banks. So resolving a big bank has never been tested. And the idea that you could bail in large quantities of capital and essentially blow those losses through the system, is a proposition which hasn't been explored. Now, ring fencing also suggests, if it's going to work, that you would do that you would blow losses through the system, which is what bail-in basically is. You basically say to somebody who had a debt contract, you don't have a debt contract anymore. It's an equity contract, and guess what? It's worth nearly zero. So it's the same thing. That's the fact is it's never been tested. With ring fencing, you could plausibly protect your domestic borrowers. Without ring fencing, you can't protect them. You just have to take the risk. And the question is, it hasn't been tested. We don't know it could work. Would a politician bite that bullet? I don't know. Okay. On that note, and I think we are, well, we've gone through time, so forgive me. But But I hope that was interesting. Thank you so much for your questions. Thank you so much for listening. And I very much hope to interact with you if you come on something that we do at Warwick University in the future. Thank you very much.